Good morning, all, and thanks for joining. Um, I am Ian Jaffe, as you can probably see from the Zoom banner. Uh, I'll introduce our key presenters today and then make just a few additional comments. Starting with Brian Ropp. Brian's been a team leader for our community and regional bank ratings effort over the past couple of years. Brian joined KBRA actually right before the pandemic, or right as it was hitting in March of 2020. Certainly, we were lucky with respect to timing on that. Um, um, Brian's background, for those that don't know, Brian, roughly 15 years as a buy-side analyst at T. Rowe Price. His sector coverage included U.S. regional banks. I think he was put into that role just at the beginning of the onset of the global financial crisis. So a good experience there. Brian left the asset management business in 2016 to become the CFO of a community bank in Maryland for a couple of years. And then we were able to recruit him, which, as I said, has been great. Joining Brian are two of our other senior team members, two colleagues, John Rempe and Stephen Yates, both of whom are directors on KBRA's bank ratings team and have extensive experience following community and regional banks. We picked this team. Among the three of them, Brian, John, and Stephen in aggregate cover 40 of our institutions as lead analysts, and an additional 40 or so as backup analysts. Lead analysts, obviously, most directly responsible for closely monitoring and reviewing our companies on a continuous basis. Backup responsibility, similar, just not at the forefront, and your name isn't listed on the top of the report. But in any case, that represents 80, if you will, of our 150 rated banks. So that's a good group, certainly. We also have, just as a note, 13 analysts following our community and regional bank universe, and other team members certainly follow as many institutions as Brian, John, and Steve, and follow them well. But with that said, these three have certainly, in my view, as good a visibility into what's going on in our rated universe, and then more broadly the industry. I wanted to do a little plug for a future call we're planning on doing based on some research. If you find this meeting interesting and informative, we have three other senior team members that are going to do a webinar in a few weeks. They are Shannon Service, Scott Durant, and Jason Zell. And they're going to do a webinar associated with, obviously, what's on a lot of people's minds. The title of their research piece and in turn webinar will be Loan Quality Performance for Community and Regional Banks, a Historical Reflection and Prospective Analysis. So I think that will get into kind of a deeper dive about, kind of anticipated earnings power and ability to absorb a likely increase in credit costs. So that should be very interesting, not to put excess pressure on those guys. Lastly, but certainly not least, on today's webinar, we have our head of financial institutions, Joe Scott. Joe has been with KBRA for 8 years and is, pretty explicitly most directly responsible for building our broad financial institutions ratings practice, which definitely started with banks, but now incorporates broker-dealers, mortgage banks, BDCs, consumer finance companies, and asset managers. I would say in aggregate, that's more than 250 public and private ratings. And Joe, thanks for joining today. Onto the presentation. So if we're moving, let's just flip to slide 6. So which is the agenda. So basically, I'll just make a few additional comments as we look at that page, and I think we've been looking at that page. We don't really plan on focusing on specific rated institutions on this call. Happy to do that at pretty much any time other than this call. So, please feel free to contact us, lead analyst, Joe, myself, any of the presenters. We like to interact with the marketplace and give our views. Our views are in writing, but sometimes a phone call can be more worthwhile. That being said, we did receive a few questions in advance of the call, which basically asked us, for those not as familiar with our ratings and our rated universe, like what have we done since the events of March? And so what I would say is we've downgraded 5 institutions since first quarter, and they are, I just put them in kind of asset size order, Western Alliance, PacWest, Home Street, Bankwell, and then Avid Bank. So those 5. And then we've also, a handful of institutions have had their outlooks adjusted from stable to negative. And what I would say is, while it's certainly possible that additional negative actions could occur over the, call it near to slightly less near term, the significant majority of our rated institutions have stable outlooks. And Captain Obvious statement, in turn, we don't envision a lot of near-term downgrades and negative outlooks. I'll give just a slight caveat to that. We don't have KBRA doesn't have a baseline economic view. I'm not saying we don't all have our own kind of views, but I would say that, our ratings outlook definitely has an underlying kind of view that that the economy, if it does turn down into a recession, that it would not currently expected to be severe. So, but obviously we don't know. We're also, we're not Fed funds target rate forecasters, but certainly less or fewer would be beneficial to the sector, as I think we all know. So when I think about a recessionary environment, I kind of, I don't go back to the GFC necessarily, even though I lived through that certainly. I think about more like a 2002 type recession, which, just to frame for people, included a peak unemployment of just over 6% that hit about a year after the recession had been called. So that was 6.3% in June of 2003. So I don't think that if we are hit by a sharper recession, that could certainly be an impediment to rating stability for many of our institutions. So I don't think that's a surprising thing. But we're trying to rate through the cycle, but through cycles that seem, I don't know, I'll use the word normal, but not that we've had a lot of normal cycles lately. So with that, we can flip to page 7. That is just the key median ratios for our full public universe. That's about 120 institutions, accompanied by, you'll see the kind of broad statements on trends. Again, I don't think these are surprising to anyone. I would just make the comment that we use the median. It does mask, obviously, some, I'll call it greater dispersion in returns and other statistics, not really in capital, not really in asset quality, but certainly in NIM and earnings driver returns, basically. So, but it wouldn't be a distinct change. The averages were lower, but just not materially. So that's one caveat. And we will include the averages certainly in our compendium, which obviously is our written work on all the public companies that we follow. So those will be included. We're not trying to hide those in any way, just thought median was more appropriate for this presentation. So with that, I'll turn it over to my colleague Stephen Yates for a discussion focused on what everybody's, I think, most interested in. Not that asset quality won't be important, but deposit and funding costs, as well as deposit mix trends. Stephen.
Thanks, Ian, and good morning, everyone. Thanks for joining the webcast. Starting on slide 9, as expected, NIM continued to contract in the second quarter, with the median net interest margin for publicly rated KBRA banks falling 21 basis points sequentially to 3.28%. Just touching on the quarterly developments for the margin from the liability side of the balance sheet. My colleague John will touch on what he's seeing from the asset side a bit later, but the decline in NIM was attributable to a number of factors, including rising deposit costs, a continued negative remixing of deposit bases. That is to say, migration from non-interest-bearing accounts into more expensive verticals, such as traditional interest-bearing CDs and broker deposits. The medium NIM was also impacted by a utilization of more wholesale borrowings in the quarter, namely in terms of FHLB advances, Fed discount window borrowings, and then more selectively borrowings from the Bank Term Funding Program. All that said, deposit flows were relatively stable quarter over quarter, as evidenced by our 10 largest rated banks reporting essentially flat balances versus the 1Q23. Now, to be sure, many of our banks in our universe more broadly reported lower deposit balances from the previous quarter, but the decline was often, in our view, manageable in nature and small. And in select cases, some banks even reported higher period end deposit balances. And the stability in deposit flows allowed for some instances of reduced non-core funding compared to the first quarter, though in totality, we would continue to expect our banks to utilize higher levels of borrowings compared to both year-end 2022, as well as the pandemic era, as they look to maintain increased liquidity on their balance sheets, given industry stresses centered in March. Relatedly, a strategic and intentional, and in our opinion, prudent slowing of loan growth in the second quarter was an additional headwind to NIM. All that said, we note that the 21 basis point decline in the median KBRA rated NIM in the second quarter was sequentially smaller, albeit only modestly, than that seen in the first quarter when it fell 24 bips. So that's 24 basis point decline in the first quarter versus a 21 bips decline in Q2. Caitlin, we can move on to slide 10. As mentioned, deposit profiles continued to see a negative mix shift in the quarter. This trend began in 2022 as the Fed started precipitously raising rates, as well as implementing its quantitative easing program to combat inflation, making non-interest bearing balances held at banks less attractive, while also shrinking overall deposits in the system. As a reminder, the more recent trend of falling non-interest-bearing deposits at U.S. banks follows a period of rather extraordinary liquidity seen during the pandemic era, in 2020, 2021, which proved to be a temporary boon for bank funding profiles broadly, a development that has begun to reverse quite clearly this year in earnest. On the left-hand chart, you'll notice that outflows of non-interest-bearing balances accelerated in the first quarter. We think most notably towards the end of the quarter in March, following the distress at some select community and regional banks in the period. That trend continued into the second quarter, and we note that at 28% of total deposits, non-interest-bearing balances are back to similar levels seen pre-pandemic. Taking a look at the right-hand chart, robust loan growth in 2022 saw bank loan-to-deposit ratios rise, though they never quite peaked at pre-pandemic levels. The median loan-to-deposit ratio fell to 84% in 2Q23, as banks dialed back loan growth in an effort to maintain liquidity. in capital. Caitlin, we can go to slide 11. While deposit costs rose by a median of 42 basis points in the second quarter, we highlight that 2Q23 was the first period where deposit costs rose less than that seen in the preceding quarter, suggesting that, assuming no surprises from monetary authorities on rate hikes, the worst of the climb in deposit costs could be behind our banks. That's not to say that deposit costs will not rise in coming quarters. They almost certainly will, but rather, we think that the sequential quarterly increases may trend lower from here. Interestingly, we noticed that in 2Q23, some of our banks with the traditionally lower cost deposit franchises saw some of the comparatively larger quarterly increases in deposit costs compared to peers. And while we're careful not to call a trend based on just one quarter of data, our team is watching for whether or not banks that lagged on passing higher rates to customers in the earlier periods of this tightening cycle may otherwise have to begin to play catch up versus banks who moved earlier and more earnestly. And while not currently our base case scenario, we also recognize the potential that, if the Fed were to keep interest rates higher for longer than expected, deposit costs at our rated banks may ultimately kind of converge and reflect less dispersion and kind of begin to congregate in a narrower band than currently exists. So that's something we're watching intently, as it's been well over a decade since bank analysts have really had an opportunity to evaluate the differences between deposit profiles. Moving on to slide 12. Great. Management team commentary on earnings calls, as well as our own channel checks, painted a decently positive outlook in terms of deposit costs in coming quarters. Generally speaking, management teams expressed optimism that deposit competition began to moderate in the back half of 2Q23. The pace of mix change is anticipated to slow, given that some of the more aggressive pricing on deposits occurred most violently in the short period after the events of March. And then we heard a lot of management commentary forecasting that they may not be as aggressive in the second half of the year on deposit pricing as they had been in the first half. Still, we would highlight that the performance of bank funding profiles in the second half of the year is likely going to be a tale of the have and have-nots. We continue to believe that our rated banks with a larger amount of low-cost, sticky retail deposits will likely outperform those that are more commercial or public fund focused. Additionally, banks with wider product offerings, whether that be treasury management or payment platforms, may also recognize the benefits of stickier deposit relationships, who may elect to remain with their institutions for reasons other than just purely interest rate paid. And then finally, banks entering the back half of the year with lower loan to deposit ratios and existing strong levels of balance sheet liquidity may be under less pressure than peers to chase higher cost deposits in the back half. So we're keeping an eye on all that. And then, just concluding on this topic, we would expect deposit costs to continue to rise in coming quarters, but barring any surprises from the Fed, the absolute worst of it may be behind the banks, but we'll be keeping a lookout. So with that, I'll pass it over to John.
Yeah, thanks, Stephen, and good morning, everyone. Thanks for joining us today. So, Caitlin, starting on page 14 here. So after peaking in the fourth quarter of 2022, Profitability for KBRA rated banks is measured by ROA, of course, has unsurprisingly declined in the first half of 2023. The improvement in the earnings profile for our rated banks in 2022 was supported by rising interest rates and the immediate repricing for earning asset yields, notably for our banks with largely floating rate loan books, while deposit costs, of course, lagged a bit. With that said, as the Fed's most aggressive rate hiking cycle in terms of magnitude and velocity started to make more headlines, causing more depositor awareness, as well as the bank failures in the first quarter, that altogether resulted in a significant rise in deposit costs in the second quarter and throughout 2023, as Stephen alluded to. As such, we have seen meaningful NIM compression more often than not for most of our banks this year, ultimately causing the decline in profitability. And then taking a look at non-interest income, it's been a bit of a mixed bag. Line items such as deposit service fees and interchange have been mostly stable, while mortgage banking has remained very low in terms of production and gain on sale premiums. And wealth management fees have been somewhat hampered given the volatility in the equity and bond markets. Just to give some more color, the lack of affordable housing is certainly a factor, and that will continue to weigh on mortgage banking revenues for periods to come, especially compared to the cyclical highs experienced in 2020 and 2021. But we did see some improvement sequentially in terms of origination volume and gain on sale margins in the quarter. And then for wealth management fees, which often lag the broader market from the timing of recognized fees, that could be a bright spot in the third quarter, just given the recent rise in equities. And then lastly, on the expense side, given the revenue headwinds, some bank management teams are doing their best to cut costs in any way that they can, whether that be through reduced headcount or just really cutting any other non-essential expenses, obviously to help support their bottom line returns. With that said, some banks, continue to invest in technology and in people for the future for when, operating conditions do improve. And then with regard to provisions, we have seen a rise, or I should say more of a normalization in credit costs, which will continue to be a more significant factor in earnings results moving forward, just given the volatile level of provisioning and reserve releases that we witnessed in prior years due to the pandemic. The decline in commercial real estate price indicators in the quarter was often mentioned by management teams as sort of a rationale for the recent rise in provisioning during the quarter. With that said, as Stephen mentioned, many bank teams are slowing loan growth, so that should help ease provision expenses to a certain extent. Caitlin, you can switch to page 15. So on this slide, you can see the average cost of deposits and how that's impacted the net interest margin for our rated universe. And given that Stephen has covered the deposit and funding costs and the overall impact to NIM, I'll try to give some color on what we're seeing on the left side of the balance sheet. Given that most of our banks that we cover are commercial lenders, that generally includes a higher level of CRE. Given that the structure of these loans are typically fixed or adjustable rates, that sort of has limited the upward repricing in loan yields, just given that many of our banks haven't had a material amount of loans repricing so far in 2023. So given this, a substantial amount of the increase in the average loan yields over the past year has been from strong loan growth and a higher level of volume, in which banks are obviously putting loans with market rates on the books. With that said, with most banks guiding to slower loan growth in the back half of the year, or at least being more selective with credits, given the uncertainties on the horizon, there's going to be less opportunities to increase loan yields through volume. Some other headwinds that we've seen for margins over the past year have also been a significantly lower level of loan prepayments, which obviously impacts the margin in two ways. The first being that loans aren't paying off and repricing at higher rates, and the banks don't get the benefit of prepayment penalties and loan fees, which oftentimes can be a meaningful portion of the overall margin. So that begs the question, what levers can banks pull? Just with our discussions with management and listening on earnings calls, banks have been more active in utilizing rate floors on new loan production to mitigate to the downside in the event the Fed starts cutting rates. We've also seen banks utilizing balance sheet hedges to improve asset sensitivity, including interest rate swaps. And in some one-off cases, we have even seen banks selling a bulk of securities for a one-time loss, just taking the hit and utilizing that excess liquidity to pay down borrowings or any other type of non-core funding, or even investing that cash into higher yielding floating rate securities as a NIM tailwind. Then lastly, and this is specifically for banks that we cover with excess liquidity, which has notably been tied up in the securities portfolio, they're using cash flow or maturities in the securities book to reinvest that cash into loan growth, which at times, are coming on the books at rates between 7% and 8%, and even higher for loan products like C&I and C&D. So loan growth can still be a tailwind for earning asset yields, but really only for banks with excess liquidity, where that marginal cost of funding isn't as high, and obviously not going to be to the same extent that we've seen over the past year. Caitlin, we can switch to page 16. So on this page, you can see some select quotes from bank management teams on NIM and profitability. The general theme that we've heard from listening in on banks' earnings calls is that management teams are seeing NIM headwinds easing and forecasting for just a little bit of pressure to maybe some stabilization in the third quarter, which is, certainly a positive. With that said, we can't start celebrating quite yet, as we can't really expect any NIM expansion anytime soon until there's more clarity from the Fed, if they're pausing rates for good or potentially cutting rates, or until there's some normalization in the yield curve. So a lot of factors at play there. So just to summarize, despite the NIM headwinds and reduced level of profitability for our banks throughout the first half of the year, the median ROA was just around 1% for all of our publicly rated banks. So they're still in pretty good shape overall. With regard to our forecasts and trying to estimate a trough in NIM and ROA, that's still very tough to say, but it seems like, there could be a modest decline in the third quarter before maybe stabilizing in the fourth quarter, which is in line with what most of our banks are guiding to on earnings calls. But the big question is, when will credit costs start to rise from an actual increase in problem loan? Because that's definitely a big factor and impact to bottom line returns. So with that being said, I'll turn it over to Brian to review credit quality.
Thank you, John, and good morning, everyone. And again, thank you for joining us today. So I'm going to hit on kind of credit quality and just kind of current migration trends. So we're going to go and first look at non-performing assets and net charge-offs, just to kind of get a sense of we view these as kind of the primary indicators of what I would argue is kind of the benign credit trends that we've been experienced with the economic environment that has held up extraordinarily well so far, despite the fact that we've had over 500 basis points of Fed rate hikes. So to date, most of the credit issues have been more idiosyncratic and with very situational, with a handful of banks having also referenced that, several of the charge-offs have had issues that date back to kind of pre-COVID. So nothing really systemic that we're kind of picking up on at this point. Again, more idiosyncratic. Just to kind of frame where our current median NPAs and net charge-offs are, and this kind of goes back to slide 7, kind of a summary. So we did see NPAs tick up slightly for our medians up to 44 basis points in the second quarter of this year. To put that number into perspective, if I go back 6 years to 2018 to kind of capture a higher rate environment through COVID, our lowest NPA median level was 34 basis points. So we're currently only 10 basis points above kind of the low point over the last 6 years. Our highest level was still even a very low 63 basis points, and that was recorded in the third quarter of 2020, kind of in that period of kind of COVID period. Conversely, if we look at the loss content in the form of median net charge-offs, that's remained extremely historically low levels. The current quarter at 5 basis points. That the NCOs have maintained a very tight range with our low point of 2 basis points, which was recorded in the second half of 2020 or 2022. That was in the second quarter, and then the third quarter. Both quarters had medians of 2 basis points. Can't get much lower than that. But interestingly enough, the high for this trend period was a high of 9 basis points, which followed in the fourth quarter of 2020. Again, kind of that COVID period. So if you look back over this last 6 years and even include COVID period as well as a higher rate environment, we would argue that it still has maintained a fairly low benign credit environment as far as kind of the loss content that the banks have experienced. So we believe these ratios are a little bit more backward looking. So we're going to look at what we focus on as far as commercial measures or measures that kind of give us a little more of a leading indicator of on the commercial lending side. We monitor the credit migration trends for the bank's risk rating regime, which reflects the bank's internal credit evaluation of its commercial loan portfolio on a loan by loan level. So if we look at slide 18, I kind of outline the typical rating scales used by banks. This can differ. Each bank will adopt their own kind of rating scale, but this is kind of representative of how a bank would look at it. The movement between loan balances between the various risk ratings provides some level of what we'll call signaling of the underlying credit, either improvement or deterioration. Unfortunately, at this point, we would argue that the signaling effect that we're getting from our banks is somewhat mixed. It's not what I'll call a clear signal. We have banks that are continuing to see positive credit migration or underlying credit improvement. And we have a handful of banks that have experienced some credit deterioration, but that's really more on a one-off and more situational. So at this point, a lot of our banks, depending on what markets they serve, are still seeing continued credit improvement. As we look for that proverbial canary in the coal mine, we've seen some increases in delinquency rates among indirect auto or unsecured credit from some of the credit unions that we rate. And although our rated commercial banks have primarily shown a continuation of the benign credit environment, as I said. So Caitlin, we could move to the next slide to kind of hit on a couple quotes just to kind of capture some of the key things that our banks have been saying in the second quarter. So if I look at the first quote where it's kind of directing towards office and retail commercial real estate, we would agree that this is the area that warrants the closest monitoring, with office kind of more in the forefront with higher cap rates, kind of secular demand shift due to technology enhancements and work from home, and all impacting kind of absorption rates within the various markets. This should be no surprise to anyone because this has been kind of ongoing. We do feel like retail would also follow, but that would typically take kind of consumer to slow down or stop their spending. So that would be the secondary sector we're kind of monitoring. Early innings here, but we expect to see development over the next 18 months as office CRE loans kind of mature and need to be renewed with what will most likely be significantly higher interest rates under higher capitalization rates and what in theory should be weaker cash flows to cover debt service. So that's, again, something we're monitoring fairly closely. If I flip to kind of the second quote, we're in the very early stages of what I'll call credit deterioration. It typically manifests in the lower margin businesses and borrowers that maybe are a little more tied to the rates of unemployment. So small and low margin businesses and then consumers could potentially be that kind of early sign or that proverbial canary, if you will. Quote 3 kind of encapsulates a sentiment that the current credit environment remains fairly benign, and it feels like we're still a ways off from what we would term kind of more of a normalized credit cycle. And then lastly, the fourth quote, I think, kind of speaks to, with the significant jump in interest rates, which has driven up mortgage costs for home ownership, We would look to the home builders as a sector that would experience some credit deterioration with declining home sales. However, this quote kind of speaks to how the home industry has been very proactive in preparing for this cycle and in dealing with or addressing the industry headwinds. So Kellen, we move to the next slide. I'm going to kind of talk about capital trends. And one more, please. So for most of the banking industry, including the largest 100+ billion in total assets, as well as the KBRA rated banks, the industry's balance sheets grew fairly significantly with the global excess liquidity following COVID, which primarily found its way on the balance sheets in cash, US Treasuries, as well as other marketable securities. And as loan demand materialized in 2021 and 2022, the industry remixed their balance sheets, significantly boosting risk-weighted assets, thus driving down overall capital levels. CET1 as a core capital regulatory ratio that KBR emphasizes troughed in the second half of 2022 for both KBR rated banks as well as the largest $100+ billion banks. If we could flip to the next slide, please. Here we highlight an additional factor that has impacted the industry's capital levels, which is the unrealized negative mark-to-markets on the available for sale investment portfolios. This has indirectly caused much of the industry to hold investments as opposed to have them available for sources of liquidity. As far as our expectations for capital going forward, you have the NPR outstanding from the regulators discussing increased capital requirements for banks greater than 100 billion in total assets. Obviously, this may not directly impact the KBRA rated banks below 100 billion, but I would note that any new requirements which have not yet been finalized, we believe that stakeholders and market participants will expect regional and community banks to follow similar capital trends as the largest banks in the industry. Therefore, we expect the industry and specifically the KBRA rated banks to rebuild capital levels going forward through retained earnings derived from growth and earning assets over the last 2 years, and also expectations of reduced balance sheet growth. So regarding the possibility of implementing a TLAC requirement, so we do not expect this to directly impact the banks in our coverage universe that are below 100 billion. With that, I'm going to turn it over to the head of Financial Institutions Group, Joe Scott, to provide our outlook and closing comments.
Thank you very much, Ian, Brian, Stephen, and John, for your insights, and appreciate everyone's time today. And I'll just add a few thoughts before we go to questions. And some of the questions we received before the webinar have been answered, or we tried to give some clear answers to those, but we have a few more questions that we'll address. But first, my few thoughts, and I'll sort of echo Ian's comments at the beginning, where the vast majority of our rated banks continue to have stable outlooks. And what we do here at KBRA is we really strive to have durable long-term ratings. And these ratings encompass the ability of banks to manage through more difficult economic environments. And we really expect most banks to manage through the upcoming uncertainties with their ratings unchanged. That said, we've taken some select rating actions on a number of banks, and we'll continue to take rating actions as necessary on banks that significantly underperform rating expectations, whether it's profitability, notably capital, in an environment where capital ratios we expect to build quite a bit. And as they have in the past, the vast majority of banks, we really believe, will adapt to changing financial and economic parameters over time. And many of our banks are long-standing participants in their local market. Many of the banks have been around quite a long time. They've managed successfully through the global financial crisis, even back to the Depression. We have a number of banks that are well over 100 years old and continue to adapt to the financial landscape and economic landscape of the time. In addition, there remains a compelling case for relationship-focused community and regional banks that serve local customers. And we really believe these banks can continue to prudently manage risk while generating profitable operations over time. With that, let's go to some questions. We have a few more here, and we touched on some of these, but just the general expectations on commercial real estate. I know Brian touched on that, but we also produced a section on commercial real estate and our views there in the first quarter compendium. So maybe Brian, start us out on that.
Thanks, Joe. Happy to take that one. So, KBRA views commercial real estate for our coverage universe, our rated universe, as manageable for several key reasons. Office, which is clearly the sector that we believe will have the most challenges for our rated banks. Typically, that represents less than 5% of total loans. There are some exceptions to that, but in general, that number is fairly low or is working its way down. The portfolios are typically fairly granular with low loan to values. We also have regulators who are providing banks with some TDR flexibility to allow to have the customer extend out upon renewal. So we think that will give banks as well as borrowers some flexibility. And if you look at the maturity wall in aggregate, we believe it will hit the community banks more so in 2026 and 2027. So that's when the largest amount of loan balances within commercial real estate come due. So a lot of things could change between now and then. So that's when kind of the majority of the maturities kind of hit. So with that said, we are still very closely monitoring. I expect there to be some losses among our rated banks. Our banks are not immune to some of these secular issues who have commercial real estate. So we do expect some losses. But I would also refer you to, as Joe said, in our first quarter 2023 bank compendium, where we drill down on commercial real estate in a little more detail. You can find that at our website at kbra.com. And then we'll also, as Ian had mentioned, be hosting a webinar on loan quality performance for community banks in the course of the next month or so. So there's two other opportunities to kind of learn more on our views and thoughts.
Can I just add, Brian, Joe, central business district of major cities, not really where the banks that we rate focus. That's not to say that suburban office can't go bad. Loan sizes tend to be different. Not that you can't have smaller size loans go bad. You certainly can, obviously. But again, those are two other factors where I think some experts in the industry have alluded to, obviously, that central business district in major cities, scale properties. Again, you can have a lot of smaller problems, and that wouldn't be good. But the banks that we rate tend not to be of the scale to necessarily support those loans. So I'm not saying exempt on problems, far from that, but just the types of loans that are made.
And just to add about construction exposure now for the industry is a far lower percentage, particularly for community and regional banks when compared to 06, 07 going into the financial crisis. That was a huge area of loss content for regional and community banks during the GFC. So, and at the same time, I think a lot of the construction exposure is more conservative these days versus then. Back then, a lot of it was speculative tract housing with a subprime mortgage takeout, for instance, or other sorts of more aggressive mortgage takeout. So I think the nature of the exposure in construction is generally more conservative versus before the GFC, and a much lower percentage of the loan mix, importantly as well. So just to add to that, and we have a few other questions here. There's one that came in on reviewing thoughts, and we did touch on CET1 ratios during the presentation, and Brian touched on that, but review thoughts on CET1 ratios, any targets, and how that fits into currently rated banks' outlooks.
Hey, Joe, I kind of responded to that via text. Caitlin, how does that work?
Yes, so your answer will have showed up in the Q&A section.
Okay. Good.
Yeah, we can just go through some thoughts on that in addition to what you wrote, Ian.
I wrote that we don't really have targets. We don't have specific targets, noting that core capital is considered in the context of rating category. Importantly, earnings power, level trend, and expected durability, asset loan mix, both qualitative as well as quantitative assessment, the latter reflected in RWAs, and of course, core funding, including a magnified focus on durability and cost. We also consider business and to some extent regional diversity to be a potentially meaningful ratings factor. Said more simply, capital ratios are not considered in a vacuum, and there is not a capital level that we target. Happy to discuss further if that's not responsive. So Joe, maybe you can discuss further if that's not responsive.
No, that sounds quite responsive and would be along the lines that how I would view it. And as part of our capital analysis, just to add, we do a great deal of peer comparison work with peers in the same rated category. And typically for banks with BBB minus sub debt, the average or median CET1 ratio is close to 11%. So I think very comfortable at the moment. But banks that are certainly well below that number are the ones, all else being equal, would be more vulnerable from a capital perspective in our view. But we also look at, as Ian said, risk profile, banks of similar size in the same regions, and there's all these parameters that go into it. So there's no real target for the ratio, but it's more a mosaic of factors. And then we had something on that just came in on Basel III Endgame, and I know Brian gave some thoughts on that before, but it says to the effect, can you go into a little more detail regarding how you expect Basel III Endgame to impact bank capitalization and profitability? And anyone would like to touch on that one? And I could always add my 2 cents then.
Sure, Joe. I'll just say so I think right, so the NPRs basically are focused on risk-weighted asset measurement, not minimum capital change per se. I think without, I haven't reviewed the 1,200 pages, just synopsis of them. I think it's just, as Brian described, we have the view that the $100 billion plus guys will be increasing relative capital. That's not just because of regulatory capital requirements. That's also market participants, all sorts of constituencies that I think over the next foreseeable future, in an uncertain economy, declining overall deposit base based on the Fed's desire, obviously, to reduce its balance sheet and the natural effects that occur for banking system deposits, that it'll be just more important to have more capital for all types of constituencies. That may include regulators, rating agencies, and the like, but far more extensive than that. So Basel III Endgame is one factor. Marketplace is, I think, as big a factor in commercial customers, commercial counterparties, and obviously March, the speed with which that hit, was pretty surreal. So I think banks will err on the conservative. I'm not going to say irrespective of the NPR and what emerges from that. And then, as Brian certainly spoke about, and Joe, we don't think our banks immediately look to track what larger banks are doing, but there is some bias in there that if larger banks are holding more capital, what would be the argument that a bank outside of that specific capital rule would not need to? It's still an industry that people benchmark, and we think a lot of our institutions will look to do that.
Yeah, then we had one come in on thoughts on future M&A in the smaller bank space and whether the Bank of California and PacWest merger will be the preferred template going forward.
I can been fairly close to that situation. I think there will be more mergers. That was, as most people know on this call, pretty unique situation. What I would note is, and I don't think this has been particularly well picked up. The day before closes of the stocks and therefore market caps had PacWest at 1.25 billion. Not that the stock hasn't been extremely volatile, and Bank of California at I think 760, 750, let's say. So, in other words, 37.5%. If the two companies were combined into a $2 billion market cap company in a stock swap with no marks. I'll leave that, no marks aside for a second. It would have been PacWest holders 37% and excuse me, bank holders 37%, PacWest 63. So or less plus around there. So basically, with the outside private equity investors, PacWest's share drops to 47, bank a little bit, I believe. So, if you will, some dilution to the PacWest shareholders, clearly. I don't think that's going to be the standard playbook. PacWest, obviously, a California bank with not immaterial venture banking business, obviously easy to pick on them after what occurred. And so we would say, as we said in our public comment, we view the merger strategically favorably. It makes sense to us. If both companies are able to execute their respective continued kind of balance sheet downsizing in advance of the merger, the new capital comes in, this institution should be pretty darn well positioned going forward. I don't think that'll be the standard playbook for mergers. I think while this was certainly an important commercial transaction, I think that bank-to-bank mergers without new investors will be more common.
Hey, Joe, I would just maybe add real quickly, in my conversation with banks, clearly everyone's kind of aware of, where M&A may stand, that everyone knows kind of what currency they have or don't have, and it's definitely on the forefront of their thought processes. Everyone is kind of aware of kind of just the general compliance costs and potentially, costs of regulation that will continue to push banks maybe to scale up to kind of get the benefit of that scale. So it's definitely on the radar screen, but I know there's some cautiousness around kind of a potential credit cycle that kind of could be on the forefront. So I'd say everyone's aware and very much focused on it, but it seems like maybe it's a little early unless you're getting kind of a PacWest type deal.
Yeah, that's my sense as well with current equity valuation in banks. There's been some recovery, but if you look at the longer term chart, the valuations are quite low in a historical context. So that may preclude many transactions, more standard stock swap transactions in the near term. But over time, of course, M&A will continue to be a feature, but it was certainly encouraging that there was a market-based transaction for PacWest with Bank of California, and then leading private equity firms, Warburg Pincus, for instance, that participated post the GFC and a few transactions, notable transactions, committed sizable equity to the deal. Certainly a plus in my view, in our view, recognizing the value of a banking franchise in the West Coast. So certainly an encouraging transaction, but as Ian mentioned and Brian, we don't see that being the standard playbook going forward. It's more a unique case. There could be some others more on a one-off basis, but for the vast majority of banks, I think M&A will probably not be a great feature in my view, in the second half, unless there's a pretty big recovery in stock valuations. And then Brian also mentioned the uncertainty about the economy and asset quality and so on. So there's many wrinkles to this. I think that's it for the questions. And we'd really like to thank everyone today for their time. And please reach out to the team for any follow-up questions on either specific banks or the sector in general. And then also look out for our second quarter compendium that should be coming out most likely by mid-August. And then, as Ian mentioned, we'll have an upcoming webinar on loan quality and loan quality trends through various economic cycles, particularly in stress periods. So thanks everyone for their time today.